Welcome to this comprehensive exploration of Burton G. Malkiel's A Random Walk Down Wall Street, one of the most influential books in investing. First published in 1973 and continually updated, this timeless guide bridges the gap between complex financial theory and practical advice, making it an essential read for anyone looking to build long-term wealth. In this video, we'll take you on a journey through Malkiel's key concepts, from the unpredictable nature of markets to the practical strategies that empower individual investors. You'll learn why chasing hot stocks or timing the market often leads to disappointment, and why embracing simplicity, discipline, and diversification can be your strongest allies. Malkiel challenges Wall Street's conventional wisdom and introduces you to the revolutionary idea of efficient markets where stock prices reflect all available information. He argues that, contrary to popular belief, the average investor can outperform most professionals by focusing on low-cost index funds and sticking to a long-term plan. We'll also explore the psychology behind investing, as Malkiel uncovers the behavioral traps like overconfidence and herd mentality that often derail even the smartest investors. Whether you're a beginner or a seasoned investor, this video breaks down the timeless lessons of A Random Walk Down Wall Street, equipping you with the tools and mindset needed to navigate the unpredictable world of finance. If you're ready to understand how markets truly work and how you can secure financial independence, let's dive into this modern classic and uncover why Malkiel's advice continues to stand the test of time. Let's delve into part 1 of Burton G. Malkiel's A Random Walk Down Wall Street, a foundational exploration of stocks and their value, which sets the tone for the book's thesis and introduces key themes. In the opening chapter, Malkiel draws a line between two primary theories that underpin investment behavior, the firm foundation theory and the castle in the air theory. The firm foundation theory is rooted in intrinsic value, proposing that every asset has a stable foundation of worth based on its ability to generate future returns. When prices deviate from this intrinsic value, opportunities arise for savvy investors to capitalize on the disparity. On the other hand, the castle in the air theory rejects this focus on fundamentals, positing that prices are driven by collective psychology and speculative trends. Investors adhering to this view profit not from intrinsic value but by predicting and exploiting the crowd's behavior. Malkiel does not merely describe these theories in abstract terms. He animates them with historical examples. The chapter vividly recounts episodes of financial mania, such as the Dutch tulip bulb craze of the 17th century and the South Sea bubble of 18th century England. These stories are not just cautionary tales but also illustrations of how collective irrationality can inflate asset prices far beyond their rational limits. The tulip bulb craze, for instance, saw individuals trade valuable possessions for rare tulips, driven by the belief that prices would climb indefinitely. Similarly, the South Sea bubble demonstrated the dangers of speculative fervor, as investors bought shares in a company promising untold riches without verifying its actual operations. The beauty of Malkiel's storytelling lies in its accessibility. He takes what could be dry, academic concepts and breathes life into them through narrative. The tales of greed and folly are not relics of the past but mirrors reflecting the timelessness of human behavior. In this way, Malkiel subtly introduces one of the book's central arguments: that market irrationality is a constant, not an aberration, and that understanding this is key to successful investing. The second chapter, The Madness of Crowds, continues this exploration of speculative bubbles by analyzing more contemporary examples, such as the stock market crash of 1929. Malkiel paints a vivid picture of the social and economic conditions that fueled this speculative fervor. The booming economy of the 1920s, coupled with the emergence of new industries and technologies, created an environment of unchecked optimism. Investors abandoned caution, bidding up stock prices to unsustainable levels. When the bubble burst, the resulting crash wiped out fortunes and left lasting scars on the American economy. Malkiel's analysis of the 1929 crash is both forensic and philosophical. He examines the structural weaknesses in the market, such as excessive leverage and lack of regulation, but he also delves into the psychological factors at play. The collective belief in the permanence of prosperity, the herd mentality, and the fear of missing out were as much to blame as the economic fundamentals. This dual focus on the technical and the human aspects of investing is a hallmark of Malkiel's approach, and one of the reasons the book resonates with readers across disciplines. The final chapters of Part 1 expand the narrative to include speculative bubbles from the 1960s through the early 2000s, including the dot-com mania. Malkiel's recounting of these episodes is not just a catalog of financial misadventures, but also an exploration of the lessons they offer. The dot-com bubble, for instance, was fueled by the revolutionary promise of the Internet. Investors, blinded by the potential of new technologies, bid up the prices of tech stocks to astronomical levels, often without regard to the company's actual earnings or business models. When reality set in, and it became clear that many of these companies would never turn a profit, the bubble burst, causing widespread financial devastation. Through these examples, Malkiel underscores the book's central argument, that markets are not always rational and that short-term movements in stock prices are inherently unpredictable. This unpredictability, or random walk, challenges the conventional wisdom that skilled analysts or fund managers can consistently outperform the market. Instead, Malkiel argues, the individual investor is better served by adopting a long-term, disciplined approach, focusing on diversification and cost minimization. Part 1 is not merely a historical survey. It is a call to arms for the individual investor. Malkiel dismantles the myths of market predictability and professional expertise, encouraging readers to take control of their financial futures. His writing is accessible yet deeply informed, blending academic rigor with real-world relevance. The stories of speculative excess serve as both entertainment and education, illustrating the timeless truths of human behavior in financial markets. By the end of Part 1, readers are equipped with a foundational understanding of how markets operate and how they often defy logic. The lessons of history, Malkiel suggests, are not just for academics or economists. They are vital for anyone seeking to navigate the complex world of investing. This section lays the groundwork for the rest of the book, framing the discussion of market efficiency and investment strategy that follows. It is a masterclass in blending narrative and analysis, making complex financial concepts accessible and compelling. As the reader moves into the subsequent parts, the insights gained here serve as a compass, guiding them through the often turbulent seas of the financial world. Part 2 of A Random Walk Down Wall Street shifts its focus from the madness of crowds and the unpredictable nature of speculative bubbles to the intricate strategies employed by market professionals. In this section, Malkiel takes readers behind the curtain of Wall Street, illuminating the mechanics of both technical and fundamental analysis, the twin pillars of professional investing. The narrative deepens, and with it, the reader's understanding of the tools and tactics that have long been wielded by those who seek to profit in the ever-shifting world of stock markets. The section begins with a critical examination of technical analysis, a methodology that seeks to predict future stock price movements based on patterns in past market data. To the uninitiated, the allure of technical analysis lies in its apparent simplicity. It promises an almost mystical insight into the market, suggesting that by studying charts, trends, and price patterns, one can anticipate the ebb and flow of stock prices with precision. Malkiel, however, is quick to dismantle this illusion. He likens technical analysis to astrology, a practice steeped in confirmation bias and largely divorced from any objective understanding of market forces. Malkiel's skepticism is not unwarranted. He methodically explains the inherent flaws in technical analysis, chief among them the random nature of stock price movements. By its very design, the market incorporates all available information into stock prices almost instantaneously, rendering past data effectively useless in predicting the future. The charts and graphs that technical analysts pore over are, in Malkiel's view, little more than reflections of randomness, patterns created by chance rather than any meaningful underlying phenomenon. The narrative becomes particularly engaging as Malkiel recounts the efforts of technical analysts to defend their craft. Some argue that human psychology and herd behavior create inefficiencies in the market, patterns that can be exploited by those with the right tools and expertise. While Malkiel acknowledges the occasional success of such strategies, he emphasizes their inconsistency. The rare victories of technical analysts, he suggests, are more often the result of luck than skill, a sobering reminder of the dangers of overconfidence in the face of market complexity. Having dissected technical analysis, Malkiel turns his attention to fundamental analysis, the more academically respected approach to stock valuation. Unlike its technical counterpart, fundamental analysis seeks to assess the intrinsic value of a stock by examining a company's financial health, growth prospects, and competitive position. It is a discipline rooted in logic and data, and one that has produced some of the most celebrated investors in history, including Benjamin Graham and Warren Buffett. Yet even here, Malkiel tempers admiration with caution. While fundamental analysis offers a more rational framework for decision-making, it is far from foolproof. The sheer volume of variables that influence a company's performance makes accurate predictions exceedingly difficult. Moreover, the analysts themselves are prone to error, influenced by biases, conflicts of interest, and the limitations of human foresight. Malkiel is particularly critical of the tendency among analysts to extrapolate trends indefinitely, failing to account for the cyclical nature of industries and economies. Through vivid examples and sharp commentary, Malkiel illustrates the challenges of fundamental analysis. He recounts cases where seemingly solid companies have faltered due to unforeseen circumstances, and where analysts, blinded by optimism or loyalty, have failed to spot the warning signs. These anecdotes are not just cautionary tales but also a testament to the complexity of the market, a complexity that defies even the most rigorous attempts at understanding. Central to Malkiel's critique of both technical and fundamental analysis is the efficient market hypothesis, EMH, a theory that underpins much of modern financial thought. EMH posits that stock prices fully reflect all available information, making it impossible to consistently outperform the market through stock picking or timing. For Malkiel, EMH is not just a theoretical construct but a powerful lens through which to view the market's behavior. He explains EMH with clarity and conviction, illustrating its implications for investors. If the market is truly efficient, then the efforts of technical and fundamental analysts are, at best, exercises in futility. The resources spent on research and analysis are unlikely to yield returns that justify their cost. Instead, Malkiel argues, investors would be better served by embracing a passive investment strategy, one that seeks to match the market's performance rather than beat it. This section of the book is where Malkiel's narrative voice truly shines. He navigates complex theories with ease, distilling them into concepts that are both accessible and thought-provoking. His tone is authoritative yet conversational, inviting readers to grapple with ideas that challenge conventional wisdom. He does not merely present the efficient market hypothesis as a fact but as a perspective, encouraging readers to weigh its merits against their own experiences and beliefs. The discussion of EMH culminates in a critique of professional fund managers, whom Malkiel portrays as overpaid and underperforming. He marshals data to show that the vast majority of actively managed funds fail to outperform index funds over the long term, a finding that underscores the futility of chasing market-beating returns. For Malkiel, this is not just an indictment of the fund management industry but a call to action for individual investors. By embracing low-cost, diversified index funds, investors can sidestep the pitfalls of active management and achieve better outcomes with less effort. Part 2 of A Random Walk Down Wall Street is a masterful exploration of the strategies and theories that dominate professional investing. Through incisive analysis and compelling storytelling, Malkiel dismantles the myths of expertise and predictability, revealing the market as a dynamic and unpredictable arena. His critique is not just theoretical but deeply practical, offering readers the tools and insights they need to navigate the complexities of investing. As the narrative unfolds, Malkiel's message becomes clear. The market is not a puzzle to be solved but a force to be respected. The randomness of stock price movements, the limitations of analysis, and the efficiency of markets all point to the same conclusion. Success in investing lies not in outsmarting the market but in understanding its nature and working with it. This realization is both humbling and empowering, a reminder that the path to financial security is one of patience, discipline, and simplicity. With Part 2, Malkiel sets the stage for the practical guidance that follows, equipping readers with the knowledge they need to make informed decisions in an uncertain world. Part 3 of A Random Walk Down Wall Street delves into what Malkiel refers to as the new investment technology, a modern exploration of the theories and tools that shape contemporary investing. Where the earlier sections of the book laid the groundwork of investing history and critiqued professional strategies, This part shifts its focus to the academic advancements and behavioral insights that have emerged in the financial world. Malkiel embarks on a journey through concepts such as modern portfolio theory, the capital asset pricing model, and behavioral finance, all while maintaining his engaging, narrative-driven approach. The section opens with modern portfolio theory, MPT, a cornerstone of modern finance that emphasizes diversification to manage risk. Malkiel paints a vivid picture of risk and reward as two sides of the same coin, inseparable and deeply intertwined in the investment process. He describes how MPT enables investors to construct portfolios that maximize returns for a given level of risk or, conversely, minimize risk for a desired level of return. The narrative is punctuated with real-world examples and illustrations, making an otherwise abstract concept accessible and tangible. MPT's genius lies in its recognition that investments do not exist in isolation. Instead, the performance of each asset is linked to broader market dynamics. By combining assets with different risk profiles and correlations, investors can smooth out the volatility of individual holdings. This idea, while intuitive in hindsight, marked a revolutionary shift in investment thinking, and Malkiel brings it to life with clarity and enthusiasm. He walks readers through the implications of diversification, showing how even risky assets can contribute to a stable portfolio when paired strategically with other investments. From MPT, Malkiel transitions seamlessly into the capital asset pricing model, CAPM, another landmark theory that quantifies the relationship between risk and expected return. CAPM introduces the concept of beta, a measure of an asset's sensitivity to market movements. Malkiel explains how beta provides investors with a framework to assess whether a stock's potential reward justifies its risk. While the mathematics behind CAPM may be intimidating to some, Malkiel demystifies it with straightforward examples and analogies, ensuring that readers grasp the theory's practical relevance. Yet Malkiel does not present CAPM as an unassailable truth. He acknowledges its limitations, particularly its reliance on assumptions about market efficiency and investor behavior. This sets the stage for a deeper exploration of behavioral finance, a field that challenges the traditional notion of rational markets. Behavioral finance, as Malkiel presents it, is both fascinating and sobering. It reveals the quirks and biases that lead investors to make irrational decisions, from overconfidence and loss aversion to herd mentality and anchoring. Malkiel's discussion of behavioral finance is one of the highlights of Part 3. He brings the subject to life with relatable anecdotes and examples, showing how even seasoned investors fall prey to psychological traps. The chapter feels almost like a mirror, inviting readers to reflect on their own tendencies and behaviors. Have you ever held onto a losing investment, convinced it would rebound, rather than cutting your losses? Have you ever chased a hot stock, only to see it plummet after you bought in? These are the kinds of questions Malkiel prompts, encouraging readers to recognize and overcome their cognitive biases. The behavioral insights are not just theoretical musings. They have practical implications for investing. Malkiel explains how understanding behavioral biases can help investors avoid common pitfalls and make more rational decisions. For instance, he advises against overtrading, a behavior often driven by overconfidence and the illusion of control. He also emphasizes the importance of a disciplined, long-term approach, resisting the urge to time the market or chase trends. As the narrative unfolds, Malkiel addresses the rise of so-called smart beta strategies, which attempt to enhance returns by tilting portfolios toward specific factors like value, size, or momentum. While these strategies may sound appealing, Malkiel warns against overcomplication and higher costs. He argues that many smart beta funds fail to deliver on their promises, and that their performance often reverts to the mean over time. The message is clear. Simplicity and low costs remain the most reliable path to investment success. Throughout Part 3, Malkiel strikes a balance between optimism and caution. He is excited by the advancements in investment theory and the potential they hold for improving outcomes, but he is also wary of overconfidence and the temptation to chase the latest trend. His narrative voice is that of a seasoned guide, offering both inspiration and warning as readers navigate the complexities of modern investing. By the end of Part 3, readers are equipped with a deeper understanding of the forces that shape markets, and the tools that investors can use to navigate them. Malkiel's exploration of modern portfolio theory, CAPM, and behavioral finance is not just an academic exercise. It is a call to action for investors to approach the market with humility, discipline, and a commitment to lifelong learning. He reminds us that while markets may be unpredictable, our approach to investing need not be. Through diversification, risk management, and a clear-eyed understanding of our own behavior, we can chart a course toward financial success. In this section, Malkiel blends rigor with relatability, weaving complex theories into a narrative that is as engaging as it is informative. The insights gained here are invaluable, laying the groundwork for the practical advice that follows in the final part of the book. With Part 3, Malkiel cements his role as a trusted mentor, guiding readers through the labyrinth of modern finance with wisdom, wit, and unwavering clarity. Part 4 of A Random Walk Down Wall Street brings together the historical lessons, theoretical insights, and behavioral revelations of the preceding sections to craft a practical guide for investors. Here, Malkiel shifts from a philosophical exploration of the market to actionable advice, offering a blueprint for navigating the complexities of investing. His tone remains warm and conversational, like a seasoned mentor sharing wisdom hard-won over decades of observation and participation in financial markets. This final section is both a culmination of the book's themes and a reassuring manual for readers ready to take control of their financial futures. Malkiel begins this section with what he calls a fitness manual for investors, emphasizing the need for preparation and self-awareness before diving into the market. Just as an athlete wouldn't begin a marathon without proper training, Malkiel argues that successful investing starts with laying a strong foundation. This includes building an emergency cash reserve, securing adequate insurance coverage, and understanding one's financial goals and risk tolerance. These steps may not be glamorous, but they are critical for creating a stable platform from which to invest. Malkiel's advice feels pragmatic and grounded, a reminder that successful investing is as much about discipline and preparation as it is about market knowledge. One of the most compelling aspects of this section is Malkiel's emphasis on simplicity and cost efficiency. He champions index funds as the cornerstone of a sound investment strategy, extolling their low fees, broad diversification, and consistent performance relative to actively managed funds. The argument is both logical and persuasive. Actively managed funds, he explains, are burdened by high fees and trading costs, which erode returns over time. Moreover, the evidence overwhelmingly shows that most active managers fail to outperform the market in the long run. For Malkiel, the superiority of index funds is not just a theory but a proven reality, supported by decades of data. As he lays out his case for index investing, Malkiel also addresses common misconceptions and criticisms. Some investors, he notes, are drawn to the allure of stock picking or market timing, believing that they can outperform with skill or intuition. Malkiel dismantles these notions with characteristic clarity, pointing out the unpredictability of markets and the futility of trying to outguess them. He likens market timing to gambling, where the odds are stacked against the participant. The message is clear. The best approach for most investors is not to beat the market but to join it, capturing its returns with minimal friction and maximum efficiency. Malkiel's practical advice extends to asset allocation, a critical component of any investment strategy. He introduces readers to the concept of a life cycle investment plan, tailoring portfolios to an investor's age, financial situation, and risk tolerance. For younger investors with long time horizons, Malkiel recommends equity-heavy portfolios, capitalizing on the higher returns that stocks tend to deliver over decades. As investors age and approach retirement, he advises shifting toward bonds and other fixed-income assets, reducing exposure to market volatility. This approach, while straightforward, is deeply rooted in financial theory and backed by historical evidence. One of the most engaging aspects of this section is Malkiel's ability to weave financial concepts into relatable narratives. For example, he explains dollar-cost averaging, a strategy of investing fixed amounts at regular intervals, by likening it to shopping during sales. By purchasing more shares when prices are low and fewer when prices are high, investors can reduce the average cost of their investments over time. It's a simple yet powerful strategy, made even more accessible by Malkiel's knack for storytelling. Another highlight of this section is Malkiel's discussion of diversification. He explains the importance of spreading investments across different asset classes, industries, and geographies to mitigate risk. Diversification, he argues, is the investor's best defense against the uncertainty of markets. By avoiding overconcentration in any one asset or sector, investors can reduce the impact of individual losses while maintaining exposure to growth opportunities. This principle, while familiar to many, is given new life through Malkiel's engaging examples and clear explanations. Malkiel also addresses the psychological challenges of investing, a theme that runs throughout the book but takes on added significance here. He reminds readers that emotions like fear and greed can be their worst enemies, leading to impulsive decisions and costly mistakes. The key, he suggests, is to stay disciplined and stick to a well-thought-out plan, even when markets are volatile or headlines are alarming. This advice, though simple, is profoundly important, and Malkiel delivers it with the wisdom of someone who has seen countless investors falter in the face of uncertainty. The section concludes with a vision of investing as a lifelong journey, one that evolves alongside the investor's circumstances and goals. Malkiel encourages readers to revisit their plans periodically, adjusting for changes in life stages, income, and financial needs. He also emphasizes the importance of ongoing education, urging readers to stay informed about financial markets and developments while resisting the temptation to chase trends or fads. Investing, he suggests, is not about short-term gains but about building long-term wealth through patience, consistency, and a commitment to the principles outlined in the book. By the end of Part 4, readers are equipped with a comprehensive framework for managing their investments, one that balances academic rigor with practical application. Malkiel's advice is not just theoretical. It is actionable, offering clear steps that investors can take to secure their financial futures. His emphasis on simplicity, discipline, and cost efficiency resonates throughout, reinforcing the book's central themes and leaving readers with a sense of empowerment and clarity. This final section is a fitting conclusion to a random walk down Wall Street, tying together the lessons of history, theory, and behavior into a cohesive strategy for success. Malkiel's voice remains as engaging and authoritative as ever, guiding readers with the confidence of a seasoned expert and the warmth of a trusted mentor. It is a testament to his skill as a writer and educator that he can make the complexities of investing not only understandable but inspiring, leaving readers not just informed but motivated to take charge of their financial destinies. In a random walk down Wall Street, Burton Malkiel masterfully guides readers through the complexities of investing, distilling decades of academic research, historical analysis, and practical wisdom into a coherent and empowering narrative. From the speculative manias of centuries past to the cutting-edge theories of modern finance, Malkiel's journey reveals a singular truth. While markets may often appear unpredictable, success in investing is accessible to anyone who approaches it with discipline, humility, and an understanding of the fundamental principles at play. At its core, the book is a defense of simplicity and rationality in a world often dominated by noise and complexity. Malkiel dismantles the myths perpetuated by Wall Street professionals, exposing the futility of trying to outsmart the market through stock picking, technical analysis, or market timing. Instead, he champions a strategy rooted in long-term thinking, diversification, and cost efficiency. His advocacy for index funds is particularly compelling, supported by both empirical data and a deep understanding of market dynamics. By aligning one's investments with the broader market, Malkiel argues, individual investors can achieve better results than the vast majority of professionals. Equally important is Malkiel's exploration of human behavior and its impact on financial decisions. He highlights the psychological traps overconfidence, herd mentality, and loss aversion that often lead investors astray. By acknowledging these tendencies and building strategies to counteract them, Malkiel empowers readers to avoid costly mistakes and stay the course in the face of uncertainty. Ultimately, A Random Walk Down Wall Street is more than a book about investing. It is a roadmap for financial independence. It reminds readers that while markets may be unpredictable in the short term, a disciplined and patient approach can yield remarkable results over time. With its blend of historical insight, theoretical depth, and actionable advice, Malkiel's work stands as an enduring classic, offering timeless lessons to investors of all experience levels. As the reader closes this book, they are left not only with knowledge but also with confidence, the confidence to navigate the financial markets and build a secure future.